Risk off in the global markets today risk off in today's global markets as seen in today's Asia session due to the lack of clarity from US President Trump primetime speech just a while ago that does not indicate any clear sign of US military operation ceasing off in Iran. The West Texas crude oil and the Brent crude oil rallied by 5% to 6% respectively, trading back up above the key psychological $100 per barrel. And we also see a sell-off in the US stock indices future in today's Asia session, spreading a negative feedback loop across the board in the Asia Pacific stock market. And the US dollar index rallied above as expected on the retest of the 20-day moving average, and gold price continues to slide after a test at the key medium-term pivotal resistance zone at around the 4,755 US dollar level as highlighted yesterday as well. And welcome back to today's volatile session of the global markets. Today will be the Thursday, the 2nd of April. I'm Kelvin here. So before we kickstart the gist of the daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So let's have a recap what has taken shape yesterday and as well as in today's early Asia session. So all things will be centered on the situation coming out from the Middle East, which is this ongoing US-Iran war/conflict that has entered into its 33rd day as of today. All right, so what we could see is that yesterday we have a lackluster session in the US stock market. All right, so yesterday, yes, even though the US stock market rallied, but the session was rather lackluster. So the S&P gained 0.7%, the Nasdaq gained 1.18%, the Dow Jones 0.48%, and the Russell 2000 0.64%. But for those who followed my daily dose yesterday, I do warn that the rally that kickstarted at the start of this week is a dead cat bounce rally because of the longer term technical configuration that is not rosy, especially the 3-month chart of the S&P 500, the Nasdaq 100, and the Dow Jones Industrial Average, all flashing significant bearish reversal candlestick elements. And interestingly, yesterday rally on the S&P 500, the Nasdaq, and the Dow Jones Industrial Average all reacted off very closely to that short-term pivotal resistance zone that we highlighted yesterday as well. So in today's Asia session, we see the E-mini futures sliding by -1%. As we are speaking right now, trading near the session low at around 6,550. The Nasdaq 100 E-mini futures also down by -1.3%, down -1.3%, trading near the session low, all due to that stagflation risk narrative back in the forefront again after US President Trump primetime speech that occurred at 9 a.m. Singapore time. So basically, what he addressed to the nation just a while ago, 2 hours ago, nothing changed. He's still stating that the US-Iran/war conflict will potentially end in the next 2-3 weeks. But what he added in a very hawkish rhetoric saying that US will hit Iran extremely hard, and also mentioning that US will hit Iran electric plants. That means talk about those power plants that Iran nationwide will rely on for their daily economic activities if there is no deal. All right, so basically what he mentioned over here is that he didn't actually offer a very clear messaging that markets wants to hear: de-escalation. Okay, so basically he continues to up the ante, stating that if there is no deal and the next 2 to 3 weeks, US will continue to hit Iran extremely hard. So perhaps market will now realize that that's one of the reasons why US military troops has been gaining strength or amassing in significant numbers in the past few days in the Middle East. So potentially there could be some form of ground invasion. So what it means that from the Iranian side, they may not view US sincerity in terms of ending this ceasefire, and they may do continuation tit for tat attacks on Gulf states oil refinery and slash producing plants, energy and oil producing plants. So that actually created a rally into the WTI crude oil and Brent crude. So what we could see over here is that the West Texas crude oil rallied back up above the $100 per barrel. They are now up by 5%. What we could see over here, 5.4%. All right, the West Texas crude oil back up above the $100 per barrel, trading at 105 figure level, and managed to hold pretty much strongly at the rising 20-day moving average, indicating that the medium-term uptrend phase of West Texas crude oil since the gap up on 2nd of March remains intact over here. So the gap up of 2nd of March was very important because it cleared above a former major descending resistance from the 28th of September 2023 high. If this rally continues, it could potentially lead to higher oil prices heading up towards the 124.4, 126.14 level that was during the June 2022 high seen during the onset of the Russia-Ukraine conflict at that point in time. So very similar price action on the Brent crude as well over here. So Brent crude, if you look at it over here, which is the bench, also managed to help pretty strongly at the 20-day moving average, right? Trading back up above the $100 per barrel. So Brent crude is up by almost 6%, 5.8 or 5.9%, trading at 106 US dollar per barrel. All right. And interestingly, if you were to look across the board in Asia, stock market, a sea of red as well, where the Nikkei 225 is down by negative 1.9%. The Nikkei 225 futures that is trading during yesterday's US session down by much more, because taking into account of the yesterday's intraday rally during the US session is down by negative 2.76%. And very interestingly, those who follow our daily dose yesterday, we do highlight over here is that the Nikkei 225 is in a bearish mode as well on the intraday basis, as the price action on Monday and Tuesday hit the upper limit of a potential minor descending triangle range configuration that the Nikkei 225 may be evolving now in the near term. And the Hang Seng continues to remain bearish, down by negative 0.9%. All right. And if you look across the other Asia market, the China A shares market stock benchmark indices, which is the A50, is also down by negative 0.4%. The broader base CSI 300, which comprises 300 China A shares listed both on the Shenzhen and the Shanghai stock exchanges, down also by negative 0.5%. So basically a sea of red across the Asia Pacific benchmark stock indices, where we also see the ASX 200 down by negative 0.85%, the higher beta Kospi 200 down by a whopping negative 3.9%, and even our defensive STI is down also at negative 0.73%. So basically, risk off mode, stagflation risk back in the forefront. Oil prices continues to remain bullish in their medium-term uptrend phase, trading back above $100 per barrel, and that also causes gold price to fall, as well as gold is now like a risk on, risk off asset, where we see stagflation risk could potentially increase opportunity cost of holding gold. So if you look at the gold price right now, where is it? Let me very quickly take you through the gold price. Yeah, so gold is actually down negative 1.45%, trading near the session low, and it actually reacted off exactly at very close to the 4,755 medium-term pivotal resistance that we highlighted yesterday, ending that potential dead cat bounce rally that we have in play earlier on a Monday and Tuesday. All right, so that's the highlight of the global markets. So very quickly, let me touch you through the FX market. So in the FX market, I do highlight that over here is that the US dollar continues to trade within this complex sideways range configuration for close to about 11 months already, since late May 2025, to be precise, 29 May 2025. So they continues to trade in this complex sideways range configuration. Last couple of days, it hit the upper limit of this sideways range, which is 110, 100.54, where Trump's gave that so-called optimistic remark saying that he will end that US-Iran /war conflict within 2 to 3 weeks. But in today's Asia session, he mentioned that yes, he may end within 2 to 3 weeks, but in these 2 to 3 weeks, he will continue to strike Iranian assets very hard. That means there could be risk of military offensive, could involve ground troops as well, given that US ground troops has been amassing in huge number in the last 1 week or so. And we do mention that keep a close eye watch on the US dollar as it fast approaches the 20-day moving average, which is at 99.50, and that also confluence with the rising ascending trendline support, linking the lows since the year-to-date low that is being made on 26th of January this year. And indeed, price action managed to hold yesterday at the 20-day moving average, didn't fall below it. And in today's Asia session, it did a bullish reaction of it after Trump's hawkish rhetoric remarks just 2 hours ago. So indicating that there is still no clear dollar sell-off yet that has been taking shape at this moment in time. So the dollar continues to trade sideways. So in the very near term, we may continue to see some strength in the US dollar in today's session as well. All right, so later I'll touch on the intraday technical outlook. All right, so before we jump straight into the intraday technical outlook, let me share with you again on the market breadth of the US stock market to reinforce my potential view that whatever rebound that we see at the start of this week, which is a Monday, Tuesday, and yesterday, is more like a mean reversion rebound within a medium-term downtrend phase that is progressing in the US stock indices, as the 3 major US stock indices, the Dow Jones, the Russell 2000, and the S&P 500, the Dow Jones, the 3 major US stock indices. Let me share with you, which is the let me open up the chart so that you guys could have a better view. Okay, so give me a minute. Okay, so what we could see over here is that we do highlight earlier on yesterday. Let me recap again. So the S&P 500 continues to have this is a 3-month chart of the S&P 500. So 3-month chart give us a longer, bigger macro picture of the health of the US stock market. So 3-month chart of the S&P 500, we see a bearish engulfing candlestick that is formed at the end of March. All right. So despite at the last day of March over here, Trump gave out that speech saying that US Iran war will end in 2 to 3 weeks, creating that potential window dressing on the last day of the month, which is 31st of March in Tuesday, and the last day of Q1 as well. But however, with this bearish engulfing candlestick being formed, price action continues to trade below the 200-day moving average, indicating that the long-term circular bullish uptrend phase from the low of 3rd of October 2022 may have already got damaged. That means there could be further downside in play, right, for the S&P 500. So all these can be seen on the next Nasdaq and the Dow Jones as well, which I do not want to elaborate further. But all 3 of them continues to close below that 200-day moving average. So very quickly, the Nasdaq 100 also below the 200-day moving average. The Dow Jones Industrial Average as well below the 200-day moving average. And what you could see is that very clearly the Russell 2000 is trying to test that 200-day moving average, hasn't broken down below it yet. But in the 3-month time frame chart, it shows a bearish 3-month shooting star candlestick on the last day of the first quarter, which is 31st of March. All right. So, and also very quickly, let me share with you the market breadth chart of the S&P 500 after yesterday's session. So this is the end of the chart. So after yesterday's session, the component stocks of the Nasdaq 100 and the S&P 500 trading above their 50-day moving average still remains below 50%. So Nasdaq 100 component stock trading above the 50-day moving average is only at 25%. Nasdaq 100 component stock trading above their 200-day moving average is only at 43%. S&P 500 component stock trading above their 50-day moving average is only at 26%. And S&P 500 component stocks trading above their 200-day moving average is only at 47%. And let me share with you, they haven't hit a capitulation low yet. So what do I mean? So the last capitulation low was on the 8th. Give me a minute. Let me shift this. Was here on the 8th of April. All right, 8th of April, where the market shaped a bullish reversal after Trump's exposed US Liberation Day tariffs announcement. So on the 8th of April, the Nasdaq 100 stocks trading above the 50-day moving average plummeted as low as 4%. Right, so it hasn't hit that low mark yet over here. So where there's a lot of fear in the market. So at this moment in time, what I'm going to stress over here is that the market breadth of the Nasdaq stocks trading above their 50-day moving average, trading above their 200-day moving average, as well as the S&P 500 stocks trading above their 50-day moving average, and the S&P 500 component stock trading above their 200-day moving average hasn't reached a capitalization low where we see extreme fear in the market. That means, i.e., in the medium term to near term, there could be still further potential downside on the major US stock indices if oil prices continue to rise higher. And I'll share with you the WTI crude oil price medium-term uptrend phase continues to be intact. All right, that's for now the first segment of the daily dose. So let me now move on to the second segment, which is the intraday technical outlook segment. So with that, let me expand my screen. All right, so let us start with the FX market first over here. So hopefully the screen is good. All right, let me start with the euro dollar. So euro dollar, yesterday we flipped to a neutral stand over here. So the neutral stand broke above the upper limit and hit the next resistance level, which shaped a bearish reaction in today's Asia session over here. So using 116.35 short-term pivotal resistance level, so that also confluence with the medium-term descending trend line that has been in place since 10th of February 2026 high over here. Breaking below the first intermediate support at 115.15, I will tighten the short-term pivotal resistance, then I will tighten the short-term pivotal resistance from 116.35 to 115.73 thereafter. After 115.15, potentially see a retest at this week low, which is this Monday swing low at 114.55. Breaking below it will potentially open up scope towards the psychological level at 114 figure level that confluence very closely to the 13th of March swing low area. Only a bullish breakout suddenly above 116.35 that would invalidate today's bearish buyer's view to see a further squeeze up to retest the 200-day moving average at 116.73 and even 117.16, pardon me, and even 117.16, which confluence with the 50-day moving average. Graphically is the congestion area of 2nd of March and 3rd of March. So that's for the euro dollar. Next up, the sterling pound over here. So the sterling pound did a bit of whipsaw above slightly at the pivotal resistance zone over here. So we have a bit of whipsaw around it. So we will have an adjusted pivotal resistance zone for today, taking into account of yesterday whipsaw at 133.47/133.70 over here. That also confluence with the 20-day moving average, as price action now did a reintegration back below that pullback resistance line at 133.13 over here, which is this dotted pink line over here. So what we could see over here is that first support level to watch will be 132.20. Okay, give me a minute. 132.20. Let me round it down. 132.20. Okay, 132.20. Breaking below 132.20, then I would potentially tighten my pivotal resistance level to this congestion here at 132.95, right? At 132.95 over here. So breaking below 132.20 will potentially retest this Tuesday swing low area at 131.80, 131.60 level. Breaking below it may see further weakness towards 131.25 over here. So 131.25, if you go back in time, is the congestion area of 20th of November and 26th of November last year. All right, only a sudden bullish reversal and a breakout above 133.70 that would invalidate today's bearish buyer's view on the sterling dollar to see a squeeze up to revisit the 200-day moving average again that is converging at the resistance zone of the swing high of 20th of March and 24th of March at 134.30/134.50 level. All right, so that's for the sterling dollar, maintaining that bearish buyer's move with an adjusted pivotal resistance level after taking into account yesterday's whipsaw at around the pullback resistance line of that former minor trend line support from the low of 13th of March, and also has that bearish reaction of the 20-day moving average exactly. So using an adjusted short-term pivotal resistance zone of 133.47 / 133.70, 1.3370 as my short-term pivotal resistance zone, and maintain that bearish bias on the sterling pound, watching the first support level at 132.20. All right, so that's for the sterling dollar. Next up will be the Aussie dollar. All right, so the Aussie dollar also reacted off the pivotal resistance zone that we highlighted, a bit of whipsaw yesterday. So hitting the first support level at 68.83 right now and testing it. So still no change, maintaining that pivotal resistance zone 69.10, 69.38, breaking below 68.83 will potentially expose this week low, which is this Monday swing low at 68.38. Breaking below it will see further weakness as it continues to trade within this minor descending trend line that has been in place since the head and shoulder high of 11th of March. Okay, the bearish head and shoulder high since 11th of March towards 67.80, 67.60, which is so coming very close to the lower limit of this minor descending channel. Former swing high area of 7th of January 2026 over here, and also the 0.618 Fibo extension of this ongoing corrective decline since the high of 11th of March. Only a sudden bullish reversal back above 69.38 will invalidate today's bearish bias view to see a squeeze up to retest the 20-day moving average and the intersection of the 50-day moving average, and also very close to the pullback line resistance, pullback neckline, the neckline resistance of this, the former neckline support now turns into a pullback resistance of this former in a bearish head and shoulder breakdown previously on the 24th of March, and also very close to the minor descending channel resistance as well at 70 figures / 70.15. So maintaining that bearish bias on the Aussie dollar using 69.10, 69.38 short-term pivotal resistance zone. Key near-term support level to watch, which is testing right now at 68.83. Breaking down below it may expose 68.38 next. That's for the Aussie dollar. Oops, sorry. Next up, the dollar yen. So the dollar yen, yesterday we do have a bearish bias. It hit our first support zone at 158.42 / 158 figure level before shaping a bullish reversal and trading back up above the 20-day moving average again over here. Okay, which is at 158.86. All right, 158.86. All right. So very interestingly, after it printed a lower low at the 3 p.m. mark Singapore time yesterday, lower low, the RSI shaped a bullish divergence, and today it shaped a bullish breakout above the 50 level mark and above this former descending trendline resistance. So indicating that bullish momentum has started to seep back into the dollar yen at the first support level that we highlighted yesterday. So given that it's now trying to break above this trying to hit this 159.95 level. So with that, we will now flip to a bullish bias with this positive element coming in. First support level to watch will be the pullback of this former minor swing high of 1st of April that is being formed on 2 p.m. Singapore time yesterday, and the 2nd of April at 3 a.m. Singapore time, at 3 a.m. Singapore time today at 158.86. Pivotal support zone 158.42, 158 figure level, unless we have a bullish breakout above 159.95. Thereafter, I would then tighten the pivotal support to 158.86, which is the 20-day moving average. After 159.95, potentially will seek out the first resistance, the first important intervention risk level of 160.74, where previously the Bank of Japan intervened in the market to sell the dollar, buy back the yen. Above it will potentially see the long-term pivotal resistance zone coming in, which is also a intervention risk area, 161.70, 161.95. However, a bearish reversal breaking below 158 figure level will invalidate the bullish scenario on the dollar yen for today to seek out a further weakness leg towards 15750 / 40, and breaking below it may see a retest of the minor swing low area of 5th of March, which confluence with the 50-day moving average at 156.63. So flipping to a bullish bias for now, using 158.42, 158 figure level, short-term pivotal support, breaking above 159.95 will tighten the short-term pivotal support to the 20-day moving average, now acting as a key near-term pullback support area or level at 158.86. All right. So that's for sum up all the 4 major US dollar pair. So let us now proceed with the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 did a bearish reaction of the short-term pivotal resistance at 25,380. So still maintaining 25,380 as my short-term pivotal resistance, and so breaking down below the 20-day moving average again as well in today's Asia session, today's opening Asia session where it gapped down. All right, over here. So overall, still maintaining that bearish bias view. First support level to watch, 24,830, 24,765. Breaking below it, may see the current minor range support coming in, where the price action of the Hong Kong 33 representing the Hang Seng Index going to trade in this kind of sideways range since the low of 23rd of March, which is at 24,257. Only a bullish reversal back above 25,380 will invalidate the bearish bias view to see a squeeze up to test the 200-day moving average at 25,650, 25,800 level. Above 25,800 level may see a further squeeze up to revisit the minor swing high of 3rd of March, 11th of March, and 17th of March, confluencing with the 50-day moving average at 26,224. Next will be the Japan 225 that is representing the Nikkei 225. So the Japan 225 also did that bearish reaction after a whipsaw around the short-term pivotal resistance zone of 53,628, 54,095, and price action now is trading back below the 20-day moving average again. So using the short-term pivotal resistance zone at 53,628, 54,095, maintain that bearish bias view. Breaking below 52,070 may expose this complex, this minor descending channel, a minor descending triangle range support level at 50,630, 50,160. All right, so I repeat, it could be involving in this potential minor descending triangle range configuration where we see a series of lower high. Yesterday a bit of whipsaw, but still flashing a lower high as well. As price action trade below the 20-day moving average. So this will be the first support zone to watch, which is the minor descending triangle range support after 52,070 is taken down on the downside. All right, only a bullish breakout above 54,095 again will potentially revisit 55,130 over here, which is the minor swing high of 11th of March and 18th of March. That's coming very close to the 50-day moving average as well. So that is 55,130. All right, so still maintaining that bearish bias on the Japan 225 as it continues to trade within this potential minor descending triangle range configuration. All right, next up will be the Germany 30. So the Germany 30 also did a bearish reaction of our short-term pivotal resistance and trading back below the 20-day moving average, a bit of whipsaw above 23,280, which is yesterday's minor swing high during the mid London, during the opening London hours at 23,490. So heavy bit of whipsaw. So maintaining that bearish bias view, 23,280. Access at 23,490, short-term pivotal resistance level. First support level to watch, 22,630. Breaking below it may expose 21,930, 21,830. Only a bullish breakout above 23,280, 23,490 will invalidate today's bearish bias view to see a further squeeze up towards 23,930 and even 24,300 level, which is our medium-term pivotal resistance that confluence with the 50-day moving average, which is the former minor swing low of 30th of June, 30th of January, 5th of February, staging breaking down below it, and so breaking below the 200-day moving average at that point in time, and where we have that bearish reaction of it on the 5th of March. All right, over here. Okay, sorry. Next up will be the major stock indices, starting with the US Wall Street 30. So the US Wall Street 30 did exactly what as expected yesterday. We highlighted dead cat bounce since the low of Monday, where previously we have that mean reversion rebound, and mean reversion rebound hit our resistance zone on Tuesday, on this Tuesday, yesterday early Asia session, where we flip back to a bearish bias. So indeed, it has that bearish reaction. So far, level still remains the same because it hasn't broken down below 45,940. So I do not want to tighten my pivotal support. I do not want to tighten my pivotal resistance zone. So now pivotal resistance zone still remains the same, 46,710, 46,970, still maintaining that bearish bias view. Unless we have a bearish breakdown below 45,940, which is also breaking down below this current ascending trend line support, current ascending trend line support drawn from the low of this Monday, then I will tighten the pivotal resistance level towards very close to the broken down 20-day moving average at 46,515. Right, 46,515. Below 45,940 exposes 45,565, then followed by this Monday swing low area at 44,965, 44,975, 44,810. Only a bullish breakout above 46,710, 46,970 will invalidate the bearish bias view to see a further squeeze up to test the medium-term pivotal resistance level at 47,460, which confluence with the descending trend line that has been in play since the current all-time high of 11th of February. All right, so that's for the Dow Jones Industrial Average, watching closely the first support level of 45,940. Still maintaining that bearish bias view. Next up will be the SPX 500. So the SPX 500 also reacted accordingly at our short-term pivotal resistance level, a bit of whipsaw, 6,600 level. So still no change, still using 6,600 level as my short-term pivotal resistance level, maintaining that bearish bias view. Price action now is heading towards our first support level, 6,455. Only breaking down below 6,455, then I will tighten the pivotal resistance level to 6,550. So for now, still maintaining that bearish bias using the similar pivotal resistance level at 6,600. Below 6,455 will expose 6,388, followed by 6,327, 6,3290, which is the lower limit of this ongoing descending channel from the high of 26th of February 2026, and as well as the 0.1-time Fibo extension on this ongoing corrective decline from the minor swing high of 11th of March over here at 6,290. So it will be a zone 6,327, 6,290. All right, which is also the swing low area on Monday and Tuesday. Only a bullish breakout above 6,600 level will invalidate the bearish bias view to see a squeeze up to test the medium-term pivotal resistance zone at 6,648, 6,705. So still maintaining that bearish bias on the SPX, watching closely the first near-term support level at 6,455. Lastly, Nasdaq 100 also did a bearish reaction over here at the pivotal area, pivotal resistance level of 24,046, a bit of excess at 24,177. So let me slash it. 177. All right. So still maintaining that bearish bias view, 24,046, excess 24,177. Right now, watch the first support level at 23,400. Breaking below 23,400, then I will tighten the pivotal resistance level to 23,833, right over here. Below 23,400 may expose 23,085, followed by this Monday swing low area at 22,800, 22,680, which will confluence with the 0.618 Fibo extension of the ongoing minor corrective decline sequence that has been in place since 26th of February high, all right, over here. Only a bullish breakout above 24,047, 24,177 will invalidate today's bearish bias view to see a squeeze up to test the 200-day moving average again, which is also testing the medium-term descending resistance from the 28th of January 2026 swing high at the medium-term pivotal resistance zone of 24,355/24,537. So that's for the Nasdaq 100, still maintaining that bearish bias, watching closely the first near-term support level at 23,400. All right, so that sum up all the intraday technical outlook and key levels to look out for on the major global stock benchmark indices. Let us now proceed with the commodities market, starting with gold XAU/USD. So gold XAU/USD did that bearish reaction exactly of 4,735, 4,775 medium-term pivotal resistance zone over here. So price action still remains the same. First support level to watch will be the lower limit of this minor bearish flag support formation. So overall, it's still trading in a bearish flag formation, but the RSI right now is giving a pre-signal of a bearish breakdown below 4,524, 4,486 by looking at it over here. So if you draw the current support level, right, so it's breaking below its parallel support level. All right, very clearly after a bearish divergence that has been formed as well. Okay, so this is something like a parallel support level in line with the raw price action bearish flag lower limit support. All right, so given that the RSI is a kind of a leading indicator of price action because it's momentum based, breaking below its parallel ascending trendline support after flashing off a bearish divergence, also indicating there's a big risk that the gold XAU/USD may shape a bearish breakdown below the bearish flag support level at 4,524, 4,486 over here. All right, so breaking below 4,486 exposes 4,319, followed by 4,164, 4,099, which is the key 200-day moving average, and the swing low area of 23rd of March. So if price action breaks down below 4,486 over here, then potentially I could lower down my short-term pivotal the pivotal resistance level towards 4,595. That all right, so for now the pivotal resistance still remains the same at our medium-term pivotal resistance zone 4,736, 4,775. However, a bullish breakout above 4,775, also breaking above the 20-day moving average, will potentially see a further squeeze up towards 4,980, 5,039, which confluence with the 50-day moving average over here. So that's for gold XAU/USD, maintaining that bearish buyer's view, looking out for a potential bearish breakdown below 4,527, 4,486, given that the hourly RSI has given out a pre-bearish condition. Lastly, will be the West Texas crude oil. Okay, let me expand my screen. So West Texas crude oil, hourly time frame chart. So our time frame chart yesterday we have a neutrality stance. We flipped to a neutrality stance yesterday. So what we could see is that the price action breached slightly below 102.25, but managed to hold firm at the rising 20-day moving average, which is our next key support zone as well, which is the 96.44, 93.70. So using 96.44, 93.70 short-term pivotal support, flip back to a bullish bias for the West Texas crude oil. Next resistance level to watch 111.28, followed by 116.56, 119.54, which is the 4-year high, the current 4-year high that is being seen on the swing high area of 9 of March 2026. Only a bearish breakdown below 96.44, 93.70 that would invalidate today's bullish buyer's view to see a further corrective pullback extending further towards the downside towards the medium-term pivotal support zone of 88.36/86.50. All right, so that's for West Texas oil. Flipping back to a bullish bias using the rising 20-day moving average as my pivotal support zone, which is 96.44, 93.70. All right, so that pretty much sum up the intraday technical outlook of all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? All right, so today will be the Thursday over here. So Thursday, what we have during the start of the European session will be rather quiet over here. So in fact, if we go down towards the US session, will be the next data to look out for will be a tier 2 labor market data. which is the weekly continuous jobless claim and initial jobless claim. So this will be at 8:30. Give me a minute, let me remove this. I don't know why this is showing. All right, so that will be at 8:30 p.m. Singapore time over here. So market is expecting almost the same number of initial jobless claim for the week and ending 28th of March at 212K added, and continuous jobless claim will be almost the same number as well, 1,840K added versus previous week of 1,819K job added. So the higher this number indicate a weak labor market because more people are filing for jobless claim. So that will be at 8:30 p.m. Singapore time. And at 11 p.m. Singapore time, we have a Fed official Logan speaking over here. And that's about it. So bear in mind that tomorrow will be Good Friday. So the US stock market will be closed, but the FX market remains open. And some Asia market still remains open. For China, it remains open as well. So for China, we have the rating dot, which is formerly last time the Caixin private organization compound services PMI data for China. For March, they'll be out at 9:45 a.m. Singapore time. So consensus is expecting a slowdown in growth to 53.7. So if it comes down below the expected, let's say at 52 or 51, previous month February print was 56.7, that could further reinforce the ongoing negative feedback loop that's being seen on the Hong Kong stock market / China stock market as well, at least in the near term. So that'll be at 9:45 a.m. Singapore time. And despite the US stock market is closed, we still have the release of the important tier 1 labor market data in US. So that could potentially influence the spot FX market as well as the spot commodities market, because given that the US futures stock exchanges will also be closed as well. So potentially there'll be no trading in the US stock indices for tomorrow. So but the FX market remains open and the spot commodities remain open. That means gold market could still be impacted, and the spot WTI crude oil and Brent crude prices will still be impacted as well. So that will be at 8:30 p.m. Singapore time. November payroll data. So market is expecting a recovery to only 60K jobs added from negative 92K that was printed previously. For consensus on the unemployment rate remains unchanged, holding steady at 4.4%. So that will be at 8:30 p.m. Singapore time. All right, so that sum up today's daily dose of market insights. So like I mentioned, the key driver will still be oil prices coming out from the ongoing fluid situation that is out in the Middle East surrounding the US, Israel, and Iran war conflict. After Trump's remarks, it seems to us that there is still no clear signs of a de-escalation. And tomorrow, given that it's a public holiday, there'll be no daily dose. So I hope that you guys will have a restful weekend ahead. And also bearing in mind, risk management plays a pivotal role right now in shorter term approach towards the global financial markets. So have a wonderful Good Friday and a restful weekend. And we shall speak again on next Monday, 6th of April. Thank you.